The anticipation surrounding the upcoming March 2024 Monetary Policy Committee meeting is heating up as stakeholders eagerly await the decisions that will shape the economic landscape in the months to come. One of the key areas of interest ahead of the MPC meeting is the stance on interest rates. Will the committee opt for a hawkish approach to combat inflationary pressure, or they will maintain a dovish stance to support economic recovery? Recall in February 2024, the committee raised the monetary policy rate by 400 basis points to 22.75%. Let's get talking. I'm being joined by a professor of finance and capital market and also the president of the Association of Capital Market Academics of Nigeria, Professor Uche Waleke, live from our Abuja studios. Good afternoon. Thank you, Prof, for joining the program.
Thanks so much, Tolu. Good afternoon. My pleasure.
Prof, we saw that last meeting and, of course, 400 basis points was the shift that we saw. But looking ahead and considering the factors surrounding this shift by the Monetary Policy Committee, many say that the MPC should be cautious and understand all of these issues, but international affiliations or the effect of that on us and what also happens locally. Now, what do you think will really be on the front burner around that table when that meeting starts this time around, considering what happened in February?
Yeah, thanks, Tolu. Well, I think the decision will be either to hold the rates or to further tighten. I'm also sure that the Monetary Policy Committee will be considering global developments as well as domestic, developments. The global scene, one, can say that some sort of favorable news, has prevailed or is still prevailing. If you notice, in the U.S., the Federal Open Market Committee of the Fed, that's the U.S. Central Bank, did not increase rates when they met, a few days ago. Inflation is moderating, not only in the U.S. but also across, especially in developed countries. In the UK, it's the same story. The Bank of England also didn't increase rates. They held rates at 5.25%. And you also read about, decision to even cut rates in some other economies. Back home, since the last MPC, we've also seen some favorable developments, in the economy, especially with respect to the exchange rate. Exchange rates, has, been moderating. The Naira is gradually strengthening. Today we hear it's, below 1,400 Naira, to the dollar. So I think all of this will shape the decision by the MPC, next week. And I also think along that line, I don't expect that even if they are going to tighten, that the rate of increase in the MPR, monetary policy rate, will be as steep as we saw in February. Left to me, I would advise that they hold rates, members should hold rates, at least to see the effect of the one they did in February, to see how that permeates through the economy. At the time they took that decision, you recall, the inflation rate was running at 29.9%. That's for January inflation figure. Now, the February inflation figure came in at 31.7%. So, of course, there was an increase. But again, that decision was towards the end of February. We don't expect to see, the impact of that until maybe March, April. There's usually a lag, to take into consideration. So my advice to the MPC would be to hold rates. But of course, I wouldn't be surprised if at the end of the day they decide to further, tighten. According to the central bank governor, if you go by the personal statements, of the members and the manner in which they voted, at the last meeting, the MPC, the CBN governor actually voted for a 425, basis points increase. He actually voted to increase the MPR to 23%, from 18.75%. So I think left to him, the tightening wasn't really, 400 basis points wasn't really enough. So that would suggest that we should expect further tightening next week. But the point I'm making is that even if they're going to tighten, it may not be in the same aggressive manner in which it was done in February.
What is the likely impact of this tightening if it happens on the real sector of the economy, considering the impact already on interest rates? It's worrisome.
Oh yes, it's always worrisome. In this program, shortly after that meeting, you recall, I talked about the need for the MPC to also have growth considerations in their decision. Yes, understandably, the central bank has reason to worry about inflation, rising inflation. But ultimately, it's one economy we are talking about. We are talking about macroeconomic goals of low and stable inflation, of sustainable inclusive growth. Okay, so that can only come about if the two sides, by that I mean the monetary authorities and the fiscal authorities, are talking to each other and having a handshake. Okay, it would be inappropriate for the monetary authority to say, for example, I want to just focus on inflation. I don't care about growth objectives. Ditto for the fiscal authority. The fiscal authority wouldn't be saying, I'm only interested in growth. I don't bother about inflation. Let the CBN bother about inflation. And that's because you find cross-cutting issues in the two. It's not only monetary factors that are driving inflation. You also have non-monetary, supply-side factors, structural factors that the fiscal authority should be dealing with. Okay, and that's why to be able to deal with inflation effectively in Nigeria today, you need both the fiscal and the monetary side. So in taking a decision, next week, it's important that the MPC should also have an eye on growth. Should consider the impact of any decision is going to take on growth, on employment, on output, generally, because that's important. Now, if you look at the report you just gave about FAC, FAC for February allocation, listening to you, the trade shares of government shared 1.15 trillion revenue for February, which was shared in March. If you look at the composition of what was shared, you will realize that companies' income tax actually decreased. The contribution of CIT decreased. So what increased is petroleum income tax. Some other taxes increased, royalties, and so on, of course, to do with fuel. Okay, but the company's income tax component decreased. And why was that so? These are some of the questions we should be asking. Okay, a lot of companies are reporting losses today, and because they are reporting losses, of course, they are not paying taxes. And part of why they are reporting losses also because of the increasing cost of production. And one input in cost of production, of course, is the cost of credit, the cost of capital. So these are the considerations too that the MPC, must be taking effect of whatever decision they're going to take on output. Now, to also look at it this way, as I said, it's one economy. This government is targeting a $1 trillion economy before the end of the decade. So what that means is that it's important that growth is supported by all and sundry. Okay, the financial sector, the financial system, the banks, are willing to support that target, but the banks cannot support that target if they are constrained, in the ability to give credit. So there is also the issue of trying to ensure that the vulnerable, less privileged people also have access to credit. Today, the government is talking about student loan scheme. Okay, recently the Senate passed the revised the student loan bill. Okay. The government is also talking about consumer credit. So the central bank also needs to support these initiatives, by the government, through ensuring that the interest rate environment is not so high. Because if you have a very high interest environment, it will impede the success of the student loan scheme. It will impede the success of the consumer credit scheme and some other initiatives, that the government has. So the two must work together, to bring about inclusive, growth and the general welfare of the people. That's very critical.
Well, interesting stuff to expect during this deliberation, Prof. But let's assess efforts now by the CBN to address FX issues and, of course, issues surrounding trade. You alluded to that in your submission, saying we've seen the impact on the FX is about 1,400 and less, even in some cases at the moment. Governor Cardoso has been working and not making too much noise, trying to address the shortfalls, settle confirmed and debts and all of that. What's your assessment of all of these moves by the Apex Bank?
Commendable, laudable. I think the one can say to a reasonable extent that some degree of confidence has come into that market. The forex market today has built for itself some confidence level, owing in part or largely to the efforts of the central bank in recent times. We have seen, for example, the issues around transparency in the administration of exchange rate or management of exchange rate. Okay, one measure that has helped to boost that confidence is in this intentional move to clear forex backlogs. We hear today that virtually all of it has been cleared. Over $7 billion, has been cleared. But let me also emphasize, the central bank keeps saying valid claims. So the fact that all the valid claims, have been cleared, is a major confidence, booster in that market. And of course, that has been helped. What has helped that really is not because MPR was raised by 400 basis points last month. I keep reminding people who always point to that. It's majorly because of the fact that, luckily for us too, the oil price, on the average, has also risen. Today is hovering around $88 dollars per barrel. And also on the part of the fiscal authority, the government has also been working towards reducing crude oil theft. Today, as a result of the effort of the government in that direction, we've seen crude oil production increase from 1.45 million barrels per day to 1.65 million barrels per day as of December, or I think January, if we go by the reports from the MPR. So crude oil production is on the increase, oil price is on the increase, and we've also received some assistance by way of loans from some international organizations. So we've gotten from Afrexim Bank, we have from World Bank. So all of that enamored the central bank to do the things it has been able to do, settle backlogs, and also resume sales. Very important, because that also helps liquidity. Resume sales to qualified BDCs. Okay, the sanity is also introducing in that space, withdrawing the license of over 4,000 BDCs, trying to make the, if you like, sanitize the BDC segment of the forex market, and then resumed sell of forex to them. So I think that also boosted liquidity in the forex market. So with, of course, improved liquidity, what do you expect to see? You expect to see the strengthening of the naira, the appreciation of the naira, and the lowering of the exchange rate. The central bank has also succeeded, to a large extent, to also take out speculative demand, for for the dollar through the action it took on Binance. So some of the actions of the central bank in recent times, have gone a long way to reduce speculative demand, to also, boost supply. So it is the combination of this that have actually, led to the moderation that we see. And I want them to take that into cognizance also when they go in for their meeting next week, that it's not just about raising the MPR. It is important that the MPC or the central bank does not over-rely on that tool, the MPR, because of its potential. Remember, it's the anchor rate, its potential to distort, a lot of things in the economy. So, further hiking the MPR, could be counterproductive. That's my point. So I think they should keep it the way it is and see how the decision of February, see how it permeates through the economy. They have another opportunity to meet, by May. So by May, they can review their decision and also decide whether to increase or not. Let me quickly also say this, that if you look at what they did in terms of CRR, increasing CRR to 45%, again, that is hurting the banks. That is also hurting ability of banks to make credit. I know the whole idea is, of course, to reduce liquidity in the system. But if you check it critically, that 45% is about the highest, one of the highest in the world, going by the ones I've checked. In South Africa, for example, reserve requirement is as low as 2.5%. In Kenya, it's as low as 4.3%. In Ghana, where inflation rate is even a lot higher, reserve requirement in Ghana is just 15%. Okay, just yesterday, okay, Turkey, I'm sure you read it, Turkey increased their policy rate, the repo rate, to 50%. Okay, 50%. But even in all of that, reserve requirement in Turkey, is still far below what we have, about at 25%. And of course, Turkey took that decision because inflation rate in Turkey, has been came in at 67% in February.
Prof, finally, before I let you go, the outlook, many still say we have some months to get out of all of this, the effect of the reforms being instituted by government. How soon do you see prices, coming down? We see FX now, like I said earlier, below 1,400. But what is your projection, or should we look at the medium to long term? When are you expecting the Nigeria's economy starts to, that inclusive growth that we expect, we start to achieve it?
Okay, well, on the issue of inflation, remember I said the two must work together, monetary and fiscal authorities must work together.
Yeah.
Some of the things the government, yes, a handshake. If you notice, some measures the government has taken now is also rubbing off positively on inflationary pressure, talking about the opening of the borders, now talking about distribution of grains, and recently the central bank also distributed 100 billion naira worth of fertilizer through the Ministry of Agriculture. So these interventions are also expected to moderate prices, at least in the near term. Now, regarding when all of this will likely stabilize, of course that will be realistically speaking, we should be looking at maybe sometime next year, not necessarily this year. In 2024, for example, central bank has a target of 21.4%. Okay, that's even at 21.4%, the prices are still high. Okay, and that's also why I said that for prices to moderate considerably, the fiscal side must come in to deal with insecurity, to deal with rising energy costs, to ensure that our refineries are working. Okay, the moment refineries are working and we are no longer importing fuel, and pump price of fuel comes down, you should expect that inflation rates will also come down, because these are the structural issues, transport issues, power is also critical. Okay, but of course there are medium to long term issues, which is why I said we should be looking at any time next year. It's not about MPR. I tell you also why I said it's not about the MPR. Turkey increased the MPR consistently since June 2023. In June 2023, the repo rate, that's their policy rate, okay, was just about 8%. Today, it is 50%. But what has happened? In June, when it was 8%, inflation rate was around 38%, and they kept increasing the repo rate. Okay, what has happened today? The inflation rate is still at 67%. So move from 38% to 67%. Okay, in spite of the increase in the repo rate from 8%, to 50%. So what does that tell you? It's not about the policy rate. Okay, if there are other issues that are at the root of inflationary pressure, those issues should be tackled. In the case of Turkey, for example, declining external reserves, fiscal surprises, have all been contributing to that. So back home, we should also bear that in mind, that inflation is not only a monetary phenomenon. Okay, there are also cost push factors that must be jointly tackled, especially both by the fiscal and the monetary authorities. So I see a lot of, I'm positive that maybe anytime in 2025, these things, we can have some reasonable degree of macroeconomic stability.
I must thank you so much, Professor Capital Markets and President Association of Capital Market Academics of Nigeria, Professor Uche Owaleke, live from our Abuja studios. Thank you. Have a great weekend.
Thanks. My pleasure, Tolu.